So we've got the statement of cash flow here. This one was according to direct method. It's just I don't know for this module they will prefer both method or they will stick to one method. I'm not sure. But they presented a direct method here, and then it's okay. It means they will prefer both methods. This one is an indirect method. So the one who said you can't able to calculate the cash what paid to supplier, you were referring to the direct method, right? Was it you, non-driver, who was unable to calculate the cash paid to supplier?
Yes, it was me.
You were referring to the direct method.
Yes, I was referring to that one.
Okay. So normally this you have to calculate it using the T format. So you have to draft your ledger account, and then from there you go and focus on like this. There are balances brought down. It will always be the inventory. So the balance brought down will be your inventory. Let me present my. Are we both in the sales guide page 11? I need confirmation. Winnie? Noloyiso?
Yes, sir. I'm going to page 11.
Sorry?
I'm going towards page 11.
Okay.
Yes.
So let's go to the Excel sheet whereby we'll be able to present that in the form of a thingy, of a ledger, and see. Statement of cash flow. Then we do the cash paid to supplier. So on your debit, you'll have the balances brought down. So these are the opening balances. So in this case, you will use your inventories part. So as the your prepaid, if you do have, sometimes you might not have. And then on your credit, you're gonna also have the balance brought down based on what increased on the credit side. And it will also be on the opening balances, which it will be your trade payables, the increase on the credit side. Yeah. So mostly these are the things that you need to. So whatever is on debit side, it means it must be cross-referenced to the credit side as they carried down. And whatever is on the credit side as brought down, it must be cross-referenced to the debit side as carried down. So you're gonna also have the balance carried down here of your trade payables. which this will be on the closing balances. Closing balance, which will be the closing balance of your trade payables. And here on your credit side, you'll also have a balance carried down, which it will be on the closing balances of your inventory, as well as the prepayment. So now you can just start clicking the amount. So when you go to your pre-adjustment trial balance, which is found on page 8. When you go to page 8, then is where you're gonna find the pre-adjustment trial balance. So now we start plugging those amounts for the prepayment. The balance that we have for 2005 as the opening balance, it was how much? How? You're no longer responding. What is the balance that I have to put here? The prepayment, what is the balance?
But I'm looking here, isn't it supposed to be 2,600? The balancing, the opening balance.
The opening balance of the prepayment, yes. The prepaid
Yes.
expense should be 2.6 here. And then it's brought down. I mean, it's carried down. It will be
500.
500.
Yes.
And then for inventory, someone must respond. Seems like I'm not teaching one person here. What is the balance for the prepayment on the opening? I mean, the inventory.
50,000.
Then you have 50,000. And then the closing, non-never.
67,000.
67,000. Then we plug the trade payables opening balance.
Opening balance.
Of the trade payables, it
The
should be
26,000.
26,000.
Closing is 38,800.
38,800. Then from there, we will start feeling what we think should go on here, but it was not included. So it means we have to go and fill things like the cost of sale, fill things like the selling expenses if they did incur one, the salaries if there are any. So here we're gonna have cost of sale. And then we have the admin expenses. And then we have the selling expenses. The cost of sale is presented in the statement of profit and loss is how much?
250,000. Yeah, 250.
The admin expenses as presented in the statement of profit and loss,
414,800.
414,800.
Yes.
And then the selling expenses,
87,400.
okay, what happened? The admin expenses you said is 414. Let's see.
800.
It's 141. The administrative expenses are 141,800.
Okay, now let's go and check it because there might be something. Administrative expenses is 78,200 plus 63,600. Question is that did they include depreciation here? Now we have to check because if there is a depreciation, depreciation is a non-cash, it must be excluded. The depreciation is 39,000.
Note number 4, I think when they bought the new vehicle, maybe.
Okay, there's 39,000 fine for number 3. So let's do it was for a machine. A motor vehicle with a cost price of this, on which depreciation of this had been already written off, was traded in for 9,000 and the new vehicle cost 35. No other vehicle were purchased, sold during the year, but the one was purchased. So here we have 39 plus 7.4. Is 46,400.
Yeah, 46,400.
But there's something that is missing here because you see this 63,600 is not included there when we do our calculation. So if it's for non-cash, okay, yeah. Go to your depreciation. You see the calculation underneath. They say depreciation. It was calculated as follows. So they're given depreciation given. Calculation of depreciation. We've got
Page
given
number
one.
11, right? Is it page
Sorry?
number 11?
Yeah.
Okay.
We've got plant and machinery
Mm-hmm.
with 39,000 given. That one I saw it. And then now for vehicles, we've got 27,200 is for, they said a vehicle with a cost price of 14,500, which is depreciation of 7.4 had already been written off, was traded in for 9,000. Okay. So let's see accumulated depreciation on motor vehicle. You see the total depreciation, accumulated depreciation at the end is 27,200. Do you see it? From the pre-adjustment trial balance. Accumulated depreciation at the end of the year.
Yeah. Oh, yes.
It's given as 27,200. So this 27,200 is ACC depreciation end of year. So which includes the 7,400, which was written off for the vehicle which was sold. You remember the vehicle which was sold?
Yes.
So the vehicle sold its depreciation was 7,400, which it was written off already. And its cost was
14,400.
14,400 sharp. That one we can leave it alone. And we need another, the 10,000, which they less the 7,400. Minus the depreciation sold, we all with and okay, I'm going to this
1,000 units, the opening depreciation, because I see there's 10,000 on the pre-adjustment plus the 27.
okay, I can see it. So the opening depreciation sharp, and then we less the depreciation which was sold. And then we remain with the depreciation of the current vehicles that are remaining. Okay, it makes sense. So we have opening depreciation on vehicles. Which is 10,000, right? We happy, ne? Then
Yes.
we left depreciation on vehicle sold. Depreciation vehicle sold is how much? The one which was written off 7.4, right?
Mm-hmm.
So it means the depreciation on the remaining vehicle will be 2.6. This will be depreciation on remaining vehicles. We happy, ne? So if we have the remaining depreciation on the remaining vehicle, and then we had the depreciation at the beginning, I mean the depreciation at the end.
At the end.
At the end, which it was 27,000, ne?
200. 27,200.
27,200. Now we less depreciation at the end, which was 27,200. Then depreciation on the remaining vehicle is 2.6. I want to follow the logic. Okay. Opening depreciation 10,000 less vehicles sold, which was depreciated during the year 7.4. Then this is depreciation on the remaining vehicle. Then the total depreciation minus the remaining vehicle of 2.6. And the 2.4 represent the incremental, to be incremental of new vehicle. I don't, this calculation I see it, but I don't follow it. Where? Just hold on. I was questioning this incremental of a depreciation, whereby I was saying if they want to exclude the depreciation on the remaining vehicle, then because it must also form part of the current depreciation for the year. So I don't know if someone is following this, because the removal of it, I don't follow it. I don't want to lie. Anyone who follow why we say the depreciation at the end we less, because the 27,200 less the 2.6. The 2.6 was supposed to be the remaining depreciation from the beginning of the year up to including the vehicle sold. So when we less it from the end of the year minus the total depreciation incurred. This vehicle, how do they depreciate? Do they give us the method which they depreciate by?
It says the motor vehicle with the cost price 14,400 with a depreciation of 7,400 had already been written off and was traded in for 9,000 on a new vehicle that cost 35,000. So it doesn't give us
the depreciation method.
Yes.
Was this is the one which was written off, which is the vehicle sold, the 7.4. And then was traded in for whatever with 9,000, and then a new vehicle cost 35,000. And then the opening depreciation, we less the one which was sold, which I agree with that part, will remain with the depreciation on the remaining vehicles. And then no other machine or motor vehicle was sold during the year, but one additional motor vehicle was purchased. So it means they traded in with one for 35,000 and they also purchased another one. The purchase plus the 24,600 represent the purchased one, and the one which was traded in. But what about the one which was remaining? Because if we do the copy and paste of this, we can just follow it, but the logic behind here is not understandable. We can just.
So I just want to find out, maybe, isn't it that they're doing it like we would do our inventory, where we say opening inventory, we subtract the closing inventory from the opening. Maybe they're doing the same thing with depreciation, to say maybe on the closing inventory of 27,000, the 2.6 was already included.
On the 27,000, the 2.6 was already included.
No,
Yeah,
it was the 2.6 that you calculated was already included on the closing balance of that 27,200.
Yeah, I get you. Yes.
206.
Yeah, I get you. So we can take it like the method of calculating the inventory, which it makes sense then.
Yeah, I said with this, so that's the only logical explanation, to say all of them, they're saying, oh, closing inventory less opening inventory. So it would be the same with depreciation, to say we already have the 2.6 that was opening from the previous year. We're supposed to subtract it, because depreciation and this suppliers.
Yeah, ne?
Oh.
Okay, no, I understand. So let's proceed. So we'll say we have a depreciation of 24,600. Then we go back here. So it means our thingy, what do we call it? Where's that calculation? Okay, plant and machinery. So we'll say the vehicles, they only depreciated by 24,600. Then we add the 2. which is 63,600. So the 63,600 will be the one representing that portion, which must be excluded from that admin relative expense that we had of 414. It was 414. It was how much? The total that was given from the pre-thingy. Admin expense from the pre-adjustment, I mean from the single profit and loss. They gave us 141,800. From this 141,800, we can say depreciation must be excluded because it's not a cash. And the depreciation to be excluded is how much? 63.
63,000.
63,000, how much? 63,600.
600.
So when we exclude 63,600, so it means we will only left with the 78. So we're all happy. So the selling expenses is given as 87,400, ne?
Yes.
So from now on, then we can check between the two sides which one is bigger. This one will be big. It's 536,500. This one is 114. So it means the debit side will represent the balancing figure. So we put it as bank. So it's like equal then you say equal this minus minus. Which figure I didn't put it correct? 26,250, 28,200. Selling expenses. $87,400, 7,500 sharp. Then 52.6. Yeah. So we are fine with this figure, which was the one to calculate. Non-grammar.
Yes, I'm fine.
So where do you get struggle? So that we can iron that part. Was it the depreciation part or was something else?
I think it was something else because now I'm seeing it that it makes sense for them to say cash paid to suppliers and employees. I think I was getting confused because I was sort of like putting every other expense in the same in that suppliers and employees. I think now it makes sense to say I must look at inventory, payables, admin and selling only.
Yeah.
When you do it like this, it makes sense to me because I was struggling. I think I put other expenses and I was wondering where they taking them and things like that. But when you did this, the light bulb went. It lights up because I was confused.
Okay.
Honestly. Yeah.
All
I
right,
think
cool.
that's the part and the depreciation portion to say what is happening, but that logic that says debit the previous year less the current year thing is sort of helping.
Okay, yeah. All right. Okay. Anyone who have a question with regarding to cash flow? So let me go back to the study guide. So this one is just an easy part to do. It's not the issue. The dividend paid, you just say the opening balance is the opening balance plus the closing balance minus the one which is unpaid. The unpaid, we're gonna see them from the statement of financial position. The tax paid will be the same thing. The balance as appear on the statement of financial position, which is the opening balance. Then you add it with amount that are gonna appear in the statement of profit and loss. Then less your closing. So you just have to monitor the opening plus adjustment less closing. So that's how I do it. Like calculation of these are the calculation of normally it's the tax paid, the dividend, and what dividend paid. So this will be your net, your cash from operating activities. After you did your cash flow from operating activities, now you're gonna add the cash generated. Cash generated from operation, the likes of your dividend paid, the likes of your tax paid, and the interest. In more cases, they use the same formula of the opening balances, XXX here, add adjustment, and less closing balance, which your closing balance will be the one at the end of the year. So mostly they use that formula. This is the formula to be used. Happy? Anyone have a question? So if you can check from the page. Shown. page 11, you can see that format. Page 11, page 12. So the interest paid of 5.3 that's calculated by taking, you're gonna go to, you've got 7.3 as your statement of profit and loss. They give you 7.3 balance there. And then let's see if there's any adjustment regarding to the interest. Okay, you see the other income part. Like on the when we go to the interest paid on a cash flow, they said 7,300 minus 2,000. The 7.3 is the one given from the statement of profit and loss as our interest paid. Then the 2,000 was the inflow that came because we received an income from the other income. So there was a income that we received in the form of interest. So we have to less it. Does it make sense? Are we fine with the portion of the interest, the finance paid? Silent means consent. Then we can proceed.
No, we are not fine.
But you are quiet. So if I ask question, I even want to check clarity whether you are fine, and then you all quiet. So I will assume everything's fine. Okay, no, what's wrong?
Okay, you see the 2,000. Where did we get the 2,000 from?
Okay, go back to your go back to your statement of profit and loss.
Yes.
That was given on page 7. I mean page 7 or 8. Yeah, on page 9.
Page
you
9.
See, they said on the page 9 there is other income.
Yes.
You see that other income?
Yep. I see it.
Of 3,000 plus 2,000.
Yes, I see it.
So now we have to find what was happening with this. Okay, let's go to adjustment number 4. You see adjustment number 4?
Yes.
Yes, on page 9. Adjustment number 4, it says carry amount of vehicle sold is how much? Or carry amount of the vehicle traded in.
It should be 7,000, I think.
We've got a cost price of 14,400 with a depreciation of 7.4 had already
So
been
it's
written off.
7,000
So you're gonna say the 14,400
minus 7.4.
minus 7,400. You remain with how much?
7,000.
7,000.
Okay. Then the trade-in value is how much?
9,000.
Oh,
There's a difference of 2,000.
So this, it came as in the form of cash, ne?
Yeah.
It was a profit.
yes. Profit
So-
on sale of asset.
On sale of asset is 2,000. So if it's 2,000, from this 2,000, then is the one that we're gonna separate from our finance. Because this is remember, we are dealing with non-cash item. Finance cost is not a cash item. Because the profit, I can't touch the profit. This is a non-cash. We all agree.
Understood.
Yeah, me too.
So when we go to the finance cost, now we say finance cost paid. We paid an amount of how much? 5,000. 7,300. The interest paid of 7,300, which is a non-cash item, less the 2,000, which was also non-cash, because the 2,000, this one is the 7.3 is an expense. 7.3 is an expense, while the 2,000 is an income. So we offset each other.
Mm.
So when you offset them each other, they give us
5,300.
so this will be an outflow. Because these things, the interest paid is the non-cash. The dividend received, we receive them, but we can't touch the cash in that minute. So as the dividend paid. So if you can check the cash generated here, mostly the things which they were not from part of the cash in most cases. So are we fine with that? With this portion? Are we fine with this portion? Yeah, this one. Are we fine here?
I'm fine.
Yes, we fine.
Okay. So the indirect method, they're gonna do something for this part first, and then after we come back and we add the same thing here. This is the indirect method. You see, this part is what we are doing as the indirect method. Then from there, this is the repetition of what was happening in the prior method. This is just a repetition, but to arrive here, you have to first do this nyaka nyaka A. So more you account for non-cash things. Depreciation is a non-cash. Profit on sale is a non-cash. Loss on sale of a non-current asset, the 8,000 is a non-cash. The interest expense of 7.3 is a non-cash. You see, the 7.3 is now offsetting each other with the 2,000. Do you see it? This will offset each other with this. Are you happy? And then the 3,000 for investment income. This one, this. So we do that portion first, this one. Then we see our 10,500 plus the 6.3. So here, please, for an indirect method, we are doing a reverse. The profit before tax is a profit, it's normal, it's fine. But anything that's gonna come under adjustment for, you do them in reverse. Normally, this is an expense. Here you put it as an income. Profit on sale is an income, you put it as an expense here. Loss on sale is an expense, you put it as an income. Interest and expense, it's an expense, you put it as an income. Investment income is an income, you put it as an expense. Did you see that logic? this part of the reversal method. I don't know if I still audible. Since my internet is down. Can you hear me?
Yes, we can.
Yes, we can.
Can you hear me?
Yes, we can
Yes,
hear
we
you.
can.
Since my internet was a little bit down. So I was trying to elaborate on this portion, yeah, the adjustment for. So did you grasp it?
So you're saying it's a reversal, you're saying on the indirect method, or are you referring to the direct method?
Only on the indirect method.
Not do we do the reverse of everything?
Only on the indirect method. The network is.
Yeah, and we can hear you clearly. I don't know if maybe you're the one with the issue of not hearing us.
No, sorry.
We can hear you clearly.
But
Maybe you're the one who doesn't
I'm
hear
the one, I
us.
can't hear you when you respond, but now at least I can hear you. Okay, so I was saying the adjustment for is only that part we use the indirect method. Only. The rest, the direct method, you go as normal. You don't do the reversal method, whereby income you make an expense and then expense you make an income. And it's only for this part. Then from there we go down. We have an amount of 84,400. We all see it, right?
Yes.
Then we do changes in working capital. So this will be the balances. Your inventory, the receivables, the prepayment expenses, and the trade payables. So you're gonna take their balances. So you said inventory at the beginning was 50,000. Inventory at the beginning was 50,000. Let's check it. Inventory at the beginning you see was 50,000, ne?
Yes.
And then at the end now is 67. Now you ask yourself, if the inventory was 50,000 and then now it's 67, what did happen? Did you save cash or did you use more cash?
We bought more, we used cash.
That's why now it's an outflow. We all happy, ne? Now you put 17,000 as an outflow. Now they say you are trading other receivables. You are trading other receivables, they were 50,000 at the beginning of the year. But when the year finished, they are now 37,400. Question, what did happen? Did people pay too much or they didn't? Right?
No, I'm saying we got money from our debtors.
Yes, so it means it's an inflow. Happy? Now expenses. Our prepaid expenses were 2.6 at the beginning of the year. But now the prepaid, they are 500. It means we were not paying too much. That's why we saved cash. The same applies to our trade payables. You will do the same thing. Did we pay too much or didn't pay too much? In this case, they were 38.8. Now it's 26. So it means for us, we were not taking things in. We were at the beginning of the year we were on 38,000, but now we are still on 26. So it means for this year we didn't take too much things on a credit, or we were not. We didn't take. We are not taking things on too much on a credit. So it means we made an increase on our side. So you check how was the balance at the beginning. Trade and other payables, it tells us at the beginning of the year, it was sitting as
8,800.
Where is it? Trade payable. It was sitting at 23,000 I mean, 46,600. This is the beginning of the year. You have to go back here. Don't use the solution, because the solution, they just want to say big number minus small number.
Oh,
But
okay.
here you were sitting on 46,600 at the beginning of the year. But now you are sitting on 23,300. So it means you didn't take too much things on credit. You see? So yeah, I don't know. Is there anyone who have a question? Because you see now the time is gone and I'm listening.
That last part, cash generated from operations, I see. Okay, so on top here, the depreciation and all of that, is it non-cash items here? Is it cash items that we actually pay or receive the extra money?
Which part are you referring to?
Can you hear me?
Yes, I can hear you.
Because I'm offline.
I can hear you correctly, no, never.
Okay, I'm saying then on the indirect method, right? The depreciation and all of that is non-cash items, but here at cash, yeah, it is. Let me just step outside a little bit. So that I can explain this. On the indirect method, the top part is it non-cash items, and then at the bottom, when you do the dividends and the taxation, it's cash items that we can actually get the cash or pay out cash.
Yes.
Am I understanding it correctly?
Yes. Yes.
Oh, okay. I just needed clarity on that because the other one is opposite, so I get confused a little bit.
Okay, no problem. Any other question from someone? When are you writing? On Monday?
Yes.
At what time?
I'm not sure of the time. I think it's at 8. I'm not sure.
Okay. All the
Let me
best.
just quickly check.
I'm on WhatsApp. If you want to ask something, you can ask it on WhatsApp.
Can you please give me your number again, sir? Just in case.
Yeah, 072
Mm-hmm.
453
453.
5744.
Thank you.
Yeah. You have a question, just WhatsApp there, and then you must also post a screenshot of that. If it's a question, where did you derive that question, so that I can have an idea.
Okay.
Okay.
Thank you very much.
Okay, thank you.